Okay, so I think I've mentioned some of this before, but let's just be clear. Um, the income statement, there's going to be a couple of new things that happen. Okay, we were using service revenue before in the homeworks and stuff. Now we're going to use sales revenue. Okay, so this is the new r- type of revenue that we're going to be dealing with the merchandising business because they're not. It's not service revenue, right? It's revenue coming from the sale of goods. So we're going to call that sales revenue. Okay, and this is what we get from the selling high, right? Because the basic business model is buy low, sell high, right? So this is the sell high part of it. As I said, cost of goods sold. What type of account is this? Expense account. Okay, it's a type of expense. This is going to represent the buy low part of it, of this business model of buy low, sell high. These two, the sales revenue and the cost of goods sold, are going to be matched together. And so inventory is an asset, and then the time that it's actually sold, it could be months later, right? You can, if you're like Tiffany's and you're selling jewelry, you may have some piece of jewelry in inventory for months, okay? And then during that time, it's held on the balance sheet as an inventory asset, but as soon as someone buys it, it's going to be taken out of inventory and expensed as cost of goods sold and matched with whatever you sold it for, whatever that revenue was. Okay, does that make sense? This idea of the matching principle, you want to match what you bought the inventory for what you sold it for in the same period. The gross profit is just sell high minus buy low. It's like what you sold it for minus what you bought it for. But again, for the banana, that doesn't capture everything, right? If we bought the banana for $1 and sold it for $5, that doesn't necessarily mean our business is doing well. Because if we only did that one time, we still have our, if we sold one banana and made $4, yeah, our gross profit was like, the gross profit percent was great. We like made 5x what we bought it for, but we had to pay rent, we have to pay our salaries, we have to pay all the other stuff. So if I only have four actual dollars of profit, I didn't actually do well, right? So it's not just the profit margin that matters, it's the turnover. The combination of those two things will determine the profitability of this type of business. And then on the balance sheet, the big change is that we have this new asset called inventory. Okay. So again, when the merchandise business buys inventory from their vendor, it's going to be stored on the balance sheet as this inventory asset. Okay. Inventory is an asset account. Okay. And again, when that inventory is sold, we're going to convert inventory to cost of goods sold. So I'm just kind of rehashing. I think I've touched on this stuff already. So, but now, hopefully, you now have a second shot at understanding what's going on. Okay, so this is Target. Let's see. Let's just look at the balance sheet. You can see here inventory. See, it's their largest current asset. They have $12 billion in inventory. So this includes all the goods that they have sitting on the shelves of the stores, plus their distribution centers. It's all here. And this is how much they've paid for it. Okay, this is their cost basis, the buy low part of this, right? That's what the value, the dollar amount is representing that. So if you see here, this is their net sales. This is the sales revenue, 106 billion. And this is the value of what they paid for those items that they sold. Okay. So what is approximately the gross profit just as a dollar amount? 30 billion. Exactly, right? 106 minus 76 is 30. So it's 30 billion. Plus they have this is like everything else. This is like their utilities. This is like paying all the employees. This is their corporate kind of expenses. This is all the other expenses of running the business. Is this 21 billion? So you can see that by far the cost of the items that's like the largest expense, right? Those items that they're selling, that's like main cost for them, right? And then afterwards, like of that 30 they're paying all the other expenses, which leaves, just have depreciation. So of that 30, 20 goes here, or 22, and then around 2.5. So their operating income is what's left over from that. And then they have interest, and their net income is here. They have some other income tax, all this kind of stuff. So they're making, so in summary, they're selling $106 billion worth of stuff, and their profit at the end is $4 billion. Okay, so this is when they say like a low margin business, right? They're of every dollar that they're selling, they're only keeping around 5 as profit. Between the rest of it is the cost of their inventory, all their expenses to run the business, and then the shareholders are left with $5. So retailing is a very, very like it's a very difficult business because it's pretty low margin. Okay, so every dollar that you can save on buying inventory. So this is why if you work at Costco and you're a buyer, meaning the person who's like going out to the vendors and negotiating the deals to buy the inventory, that's like a super important job, right? Because if you can buy lower, you're gonna make a higher profit, and each dollar that you save is gonna like, and especially if you're buying millions of units, it's gonna translate to a lot. And of course, like, what you sell the items for, like Costco, they have the model where they're just going to mark it up 15%. So actually the buying for them is the most important part of their business. They really need to buy well because they're going to fix the profit percentage. So the buyers at Costco probably make a lot, I bet they're like very, very like, it's very hard to get that job probably. But they are like maybe some of the most important employees at the whole company. Okay. That's why, like, they're smart too. You go to Costco, I don't know if you guys who shops there, but the clothing and like the stuff they got is like pretty good. So whoever is like doing the shopping there, I think they know what the people want. I was reading that, or I was listening to a podcast. Nike, they are like want to have this image of like we're like better than Costco. So I don't know, like I think this has happened at some point because they're really desperate to sell shoes. They had just had a bunch of extra inventory. But like it's hard, like Nike will not sell into Costco, right? They want to keep their brand a little more elite than that. Okay, so but there was a moment where they were like under pressure. They really needed to generate some sales because they probably had a bunch of inventory building up. And Costco buyer, hit them up and we're like probably bid them super low, and we're able to get those Nike shoes for a really good price. So again, that's like it's a negotiation, right? When you are a merchandiser, your profit is based on buying low and selling high. So depending on what levers you can pull, you're going to try to either buy for lower or sell for higher. Okay, so this is Target, right? So this is like a retailer, and they're just kind of like everyday essentials. Let's look at Capri Holdings. This is for Versace. This is like a luxury brand retailer. Okay, so let's see what theirs looks like. Okay, so you can see here, the revenue is much lower. Okay, it's 4 billion. Their cost of goods sold is 1.6. So as a percentage, who's making more per dollar of sales? Who's making more money? So we saw with Target, they're making 30 billion out of 106. Okay, so maybe let's just do some math here. So gross profit. So they had like 30 billion out of 106. So their gross profit percentage is 28%. Okay, so this is Target. And we'll just call this Versace, but it's like some holding company that owns a bunch of brands, luxury brands. So what was it? So their gross profit is, and see, they did something a little nice. Okay, they actually did a subtotal here. So a lot of retailers will do that. See, you can see Target, they just kind of threw everything together. They didn't give you that like extra line to show you that subtotal. We just calculated in our heads, right? But these guys are a little nicer, making their financial statement a little more readable, right? That's what as we know, this is a report. It's meant to convey information to the reader. Okay, so they're doing something a little nicer. they're explicitly stating what the gross profit is at 2.8, 2.8, and their revenue was 4.4. So if I just do the same math, okay, you can see that the gross margin for Versace, or the Capri Holding, as we call it, is much, much higher. It's because they're selling luxury goods. So they're selling less of it, but their margin, their gross margin is much more. Okay, so these are two different kind of business models. And if we looked at a grocery store, it's going to be even lower than Target. Okay, grocery stores it's like the most cutthroat retail business there is. It's like so low margin. Every single dollar matters. Theft for these companies that can like eat a huge amount of their profit because it's such a low profit margin business. That's why a lot of these, like Target and a lot of these stores, close in places where there's a bunch of theft, because it will kill their whole business. So yeah, the news won't tell you that. They'll just be like, oh, the Target is like screwing the neighborhood over. But it's, in the end, it's a very, very competitive business, and they just can't afford to take those losses because they'll just be running at a loss. Because remember, this is just the gross profit. This is not including all the other expenses, right? The employees, the rent, the utilities. We saw that with Target, it was like another, it was like 20 billion, 22 billion, right? So this 30 of gross profit is actually much less after you substitute or subtract all that. In the end, these guys are actually making a loss. Though their gross margin is high, they have a bunch of selling expenses. They got to probably spend a bunch on advertising and all kinds of crap. So in the end, they're actually, see, operating expenses is more than their gross profit. So this company is operating at a loss. Okay, so this is unsustainable. Their net loss is 1.1 billion, and it looks like they had a good year a couple years ago, or a better year, but looks like this company is struggling.